which are the safest mutual funds to invest in, which are the best gold ETF investments, is it even worth getting a 1 crore insurance cover? All that and a lot more, including how I started on my personal finance journey, coming up in this video. Hello everyone, as you can see, we are changing things around in this particular video. For starters, I'm not in my home office or home studio. I'm outdoors and I'm here at Oxford University's Said Business School. Those back there are our classrooms. I'm here for a postgraduate course in artificial intelligence and business. There's a lot to share about the course, about what I am learning, which I will in due course. I have to visit Oxford about 4 times this year, and this is my first stay here. And I head back to Pune tomorrow. So I thought I'll shoot a video from the campus, and it's also a special video because I hit 500,000 followers on Instagram about 2 weeks ago, which when I started out about 2.5 years ago would have seemed absolutely impossible. So I asked my community to ask me any question that they want, and here I will be answering all those questions. A lot of them are regarding personal finance, but also about who I am as a person. So this is a wonderful way for even us to get acquainted to each other. So let's get right into it. The first question that I thought I'll address was asked by Sana, and she says, does it really help to hire a professional investment consultant, manager, or advisor? Now, let me be very clear and transparent here. I also work in the investment space. I help people manage their money. So my opinion could come across as biased, but I'll also tell you when you should work with an investment consultant and when you should do it on your own. So firstly, what is the real reason why you'd work with a professional, right? It is because you want to lean into their expertise, lean into their knowledge, and then use that to best perform when it comes to your money. And that's just not with investments, but also, like I'll give you an example. We are working with one client based out of Pune, the city where I stay, and they had sold property in a different country. And they had moved back to India 20 years ago. They had sold this property right now. So they wanted to invest that lump sum amount. And it was a significant amount. It was about 2.5, 3 crores. Now, if they had to move that money back into India, that would obviously involve some forex fees, some banking fees, which would eat into about 5 to 10% of their money at least, right? So imagine you want to invest 3 crores, and out of that, about 30 lakhs could just be eaten up in fees. But when we started working together, I told them of a service, and I'll share it right now with all of you as well. It's called TransferWise, or Wise.com as it's now called. I have no affiliation to them. They don't pay me. I'm a customer. We don't have any other relationship with them. But by using this service, which specializes in cross-border transactions, their fee went down from around 10%, which a lot of platforms, a lot of banks would charge. It went down to barely a few percentage points. And so instead of paying 30 lakhs in fee, they ended up paying 2-3 lakhs in fees at the most. So then they just had more money available to invest. And just imagine, right, the 25 lakh compounding over a long time, how much that would grow to. So when you hire a professional, that professional is spending a lot of time, every waking hour, trying to learn about their field. They're also having more conversations with other colleagues in the same field. So they kind of tend to be on top of things, right? So not just with respect to investing strategies, which is a very important part of working with an investment advisor. But let me tell you, and I'll again be honest, there is no magic one very successful strategy out there that will guarantee you money. The approach that I have is that you want to avoid making mistakes. Because if you do that, if you set up a portfolio in a very boring way, not do anything fancy, you follow asset allocation, diversification, and depending on the person that you're talking to, you allocate money in different kinds of stocks or different kinds of mutual funds. Then if you do that well, then in most cases, you're setting yourself up and your client up for success. So when people end up working with an investment advisor, they believe that it's got to do with their expertise, their knowledge, which is important, don't get me wrong. But what I have learned over the years is that people end up working with me or others like me because of our conviction in what they should be doing. Also, at the same time, if you are busy with your own work, with your own job, and you're trying to manage your family and personal life as you're managing your work, then that leaves you with very little time to actually understand how investing works, actually understanding what would be the best way for you to invest. At the same time, we are very, very emotional with our own money, and it happens to me too. When I'm looking at my own money, there's that emotional bias, that emotional layer that kicks in. Whereas if someone who's not directly connected to your money but is still looking for your best interest, is looking at it, it's handling it, then you get a very objective view. So if you're getting emotionally swayed, whether it's just getting a little afraid if the market is going down, like it has been, right? For the past 3 months now, we are down by more than 10% across all major indices in India. So just having that objective view, non-emotional view, can be very effective because it helps you zoom out. Because these 10-15% drops, they may seem big in the moment, but we all know, and I've kept talking about this on this channel, so if you're a friend of our channel, you would know about what I'm about to say, that these 10% drops are very common. They have happened in 40 out of the past 44 years. People will get bored of me saying this, but it is very, very important to understand, because in the moment as it's happening, it can be difficult. But if you're working with an investment advisor or any kind of consultant, then you're just in a better position to weather the storm. In fact, there was a study conducted by the Association of Mutual Funds in India, AMFI. And in this study, they found that people who invest in the regular plans, that is, people who are taking the help of a mutual fund distributor as opposed to a direct plan, the people who invest in the regular plans tend to have longer holding periods, which is crazy, right? Because it's a direct empirical data point that if you're working with a professional, you're more likely to stay invested, and most challenges in investing are solved if you just expand and increase your investing horizon.
Okay, now prime for question number 2. And as you can see, I've got my gloves on because it's really cold here. There's a slight breeze as well. So it makes it feel much colder than what it is. But the next question is from Shibani. And she asks, where does one get started? There's so much information online. And this is absolutely true, right? Because we're living in this information explosion where there's just so much information that you don't know who to trust. You don't know what exactly should be that first step. So I'm going to give you 2 answers here, rather 3 answers. The first is going to be, I'm going to plug in my personal finance masterclass, which I'm conducting on the 25th of January, Saturday, where I take you through a 7-step plan to set up your finances. So it includes literally everything that you would want to do, including investing, which, believe it or not, is the second last step in the process. Step number 2, I'm going to link a video somewhere on the screen where I share with you how I made a video on this, on how you can get started with investing, what are the kinds of funds you should explore. That is completely free of cost, so check it out. And thirdly, the reason people are afraid to start, or they get confused where to start, obviously there's a lot of information, but also secondly, there's a lot of fear, right? What if I invest money and the markets don't do well? Because let's be honest, we all know of that one uncle in our family who started investing in stocks and it did not end up well for that person. And then that family, that person becomes that one example that we are always getting reminded of by people around us, or we keep thinking about it to some extent. So in that case, how do you get rid of fear? And I'm going to share a very practical example. So let's say you have 10,000 rupees to invest, or that there's a surplus amount every month after all your expenses. So now in that case, of the 10,000 rupees, you don't want to invest the entire 10,000 rupees. You potentially want to start off with maybe 3,000, 5,000 rupees. Because the moment you reduce the quantum of your investments, then you are less likely to be affected by its performance. Now, this is a great way to do it if you're doing it yourself. And as you get more confident, as you feel more comfortable with the process, increase it to the fullest capacity that you potentially can invest. Uh, at times, this can take a lot of times. At times also, this can cause a lot of inertia because, again, even the 5,000 is lower than 10,000, it's still, you are investing your hard-earned money, so it can feel scary. In that case, I would again ask you to look around uh, at your friends, ask them if they are working with a professional. If they are, ask them if they're happy with them. If they're happy with them, see if you can get introduced to them and start working with a professional. Because especially when you're starting out and there are so many things to look at, so many things to consider, it just helps to get a professional opinion. Someone who can sit down with you for half an hour, 1 hour, understand your perspective, and then you can literally call them up any time that you want. So if you're confused where to start, ask for a referral of an investment consultant, advisor, professional, and that's how you'll get started right away. Okay, so as you can see, a slight change in scene for one of the most important questions, because I had shot it outside before the file got corrupted, and I'm flying out back to India tomorrow morning from London. So this is our only chance to record from here. So it is an important question. So let's get into it. And this is Madhur asking me, what is a safe way to invest? Now, I'm assuming here that by safety, you mean that once you invest, the money value doesn't fluctuate as much, or even if the markets are not doing well, like it has been the case, right, for the past 3 to 4 months. Even in that case, the fund that you are investing in potentially falls lower. So, if that is your definition of safety, then the best way to invest potentially, even if you're a new investor, you want to test the waters, is through one of two options. Firstly, something called as a balanced advantage fund, and secondly, something called as a multi asset allocation fund. So, what does a balanced advantage fund do? Why is it safer than other funds out there? It's quite simple. It all comes down to asset allocation. So, balanced advantage, the name kind of suggests that there's a balance of two things, right? Or multiple things. So, in these funds specifically, there's a balance between stocks and bonds. So, the amount of investment that goes into stocks in these particular funds is lower than your traditional, say, Nifty 50 or mid cap or small cap fund. How much lower? It varies. It's like a balance, it's like a seesaw. The fund managers, if they think that the market is not going to do well, they'll reduce the stock allocation. If they think that the market is going to do well, they'll increase the stock allocation. So, just about a couple of months ago, some of the biggest balanced advantage funds in India, specifically two, right? Two of the oldest ones, the biggest ones, offered by HDFC. It's called the HDFC Balanced Advantage Fund, and the one offered by ICICI Prudential is called the ICICI Prudential Balanced Advantage Fund. Both of these had about 50% of their money in stocks, and the remaining 50% was either held in bonds and some in cash, which was uninvested money at that point in time. Now, this has big implications, and this again has a direct role to play in how safe your investment becomes. Because think about it, right? If you're investing in a Nifty 50 fund, and you're, let's say, investing 10 lakh rupees, then an entire 10 lakhs is getting invested in the stock market. So if the market goes down by 20%, your 10 lakhs is essentially down to 8 lakhs. So you have a notional loss of 2 lakhs. Now, in a case where only 50% of your money is in stocks, only 5 lakhs gets invested, right? And in that case, if that 5 lakhs, there's a 20% drop, then you're down by about 1 lakh. On the other hand, the other 5 lakhs is getting invested in the bond market. And the bond market, for all intents and purposes at that point, is going to give you a positive return. So let's assume even a low positive return rate of, let's say, 5%. It will be slightly higher, but let's assume something very conservative, very straightforward of 5%. Now, a 5% growth on your remaining 5 lakhs is going to give you 25,000 rupees in additional notional profit. So if you now think about it, your total notional loss is 75,000, right? The 1 lakh negative from the stock market, but plus 25,000 from the bond market. So this is a wonderful way to balance both risk and returns. And in this case, if you then compare the two scenarios of investing all your money in the stock market versus investing in such a way where you both have stocks and bonds, in the stock market, you would have been down to 8 lakhs, whereas in the balanced portfolio, you would have been down to about 9.25 lakhs. Now, you may wonder that, okay, this shields you when the markets are not doing well, but what about a situation when the markets are doing well? Does this also reduce your returns? Let me tell you something very interesting. One of the oldest balanced funds in the Indian stock market, the HDFC Balanced Advantage Fund, and again, this is not a sponsored video by any means. I'm only quoting it because it's a 30-year-old balance fund. In fact, past 30 years now, launched in 1994. That has actually returned more than the Nifty 50 over that time frame. So something to think about. And one of the rationals for that is, yes, the stock picking in the fund was done by the legendary Prashant Jain, and he is considered to be a master stock investor. Now has exited HDFC, has started his own investment fund. But you can argue his stock picking was great, but at the same time, even after he exited, the fund has done very well. So it may all come down to this balancing risk, because if in a downturn you fall lower, then when the markets again start going up, you start increasing your portfolio value from a higher point, right? Instead of 8 lakhs, you're now going up from 9.25 lakhs. So that's one type of fund, a balance advantage fund. The second I mentioned was a multi-asset allocation fund. This is essentially a multi-asset fund. It invests in various assets. So like the balance advantage fund invested in 2 assets, multi-asset allocation fund has to invest in at least 3 assets. So the common ones are you have equity, just stocks, you have bonds, and then you have gold. A lot of these funds also have REITs, which are real estate investment trusts. There's usually a very small allocation to REITs given in these funds. But again, the same principles apply, right? Gold is considered to be an asset that does not do well traditionally when the markets are doing well. And when the markets are not doing well, it's traditionally known to have done well. That has kind of changed a little, the correlation between the two assets. But even then, right, gold had a wonderful year in 2024. And something to think about once again, because the moment you're splitting your money across different assets, some of them don't move in sync with the stock market, you automatically start diversifying your risk. So that's how you start investing safely. And I hope this helped you out. Moving on to the next question, which is asked by Ajay. And this is, which is the best gold ETF mutual fund? Now, the way gold ETF mutual fund investing works is that there's a mutual fund, and the mutual fund invests in a gold ETF. An ETF is short for an exchange traded fund. So it is trading on the stock market like any other stock. Now, the challenge with investing directly in a gold ETF is that it is very difficult to do an SIP in them, right? Because it's tricky to get an SIP started in direct stocks or ETFs. Some platforms now allow it, but at the same time, there are some logistical, I think, challenges that you would face when you do that. So then the best way to invest in gold ETFs is through mutual funds, according to me. And while doing that, you need to be careful about two things. So the ETF, the underlying ETF which the gold mutual fund is investing in, has an expense ratio. So that is the fee that the manager of that ETF is charging you to invest in that fund. Then we also know that mutual funds have expense ratios. So in terms of gold ETF mutual funds, there are two expense ratios that you need to be careful about. And I'm going to make your job very easy by sharing with you two names of gold ETF mutual funds that have the lowest fees associated with them. So the lowest cost gold mutual fund in India is the ICICI Prudential Regular Gold Savings Fund, where the mutual fund itself has an expense ratio of 0.09%, so very low cost, and the ETF has an expense ratio of 0.5%, so the total expense ratio is 0.59%. Then the second mutual fund in this space that you can consider is the SBI Gold Fund. And SBI Gold Fund has the mutual fund has a total expense ratio of 0.1%, so marginally higher than ICICI Prudential's, but its ETF has an expense ratio of 0.65%. So that takes, the total fee associated to 0.75%. And, both of these are legacy brands, big brands, brands of pedigree, so you can consider any one of them. Then Prakash asks me a personal question. He asks me how I got started in the world of personal finance. So, if I give you the long version, right, and I think I will, because we're doing this video very differently, so I'm talking to you in a very relaxed, casual manner. The way I usually talk to anyone right across the coffee table. I try to do that in my other videos as well, but the moment you have light, you have camera, it just it just puts you in a different state where you're more energetic. So my earliest memory of my father was of when I was, I think, 2.5, 3 years old, and he was sitting cross-legged and he was reading a yellowish tinge paper, which was the Economic Times. And that was an activity that he did every single day without fail. Okay, he also got the Business Standard on a few days, which is by the Hindu group. And I was always fascinated by what is he reading exactly. And then I would also pretend to sit cross-legged and open the same newspaper, which was 2, 3 times bigger than me at that age, right? And obviously at that age, I did not understand anything, right? I could perhaps even barely read. Perhaps I just started learning letters. But my father, my dad, he played a very crucial role in getting me just excited about the world of money. So by the time I was 8, 9 years old, I was able to read and understand things. Again, the understanding was very, very surface level. But because he was doing it, because it was something that he was passionate about, I just kept following his footsteps. And that carried on as the years rolled. And when I was 13 years old, which was a very pivotal year in my life and in my family's life, because when I was 13, my father had a routine hernia operation And there was a complication in that operation because of which his brain could not get oxygen for 6 to 7 minutes. And um, post that, he was in coma for a few weeks, about 3 weeks. The doctors at that point told us that there was no scope for him to recover. And we were obviously, you know, absolutely shocked and unable to understand what was happening as a family, right? But as things go by, touch wood, by God's grace, Dad made it through. Doctors had given him no chance. Now, 16 years, 17 years down the line, he's still dependent on us. From a cognitive perspective, he's not able to entirely comprehend things, not able to articulate things, not able to move on his own. But he's still with us, and as a family, we are absolutely thrilled about it. One thing that that incident did, right, was um, it changed the trajectory of my life and of our family, because my father was the main earning member of our family, and he had a practice in the finance space. He worked in insurance. He had just started working with mutual funds back then as well. And because he was the only earning member and he could not work anymore, my mother, who at that time was a kindergarten teacher, had to take over his practice. And this happened in 2 years, right? Because we always thought that he would get better and get back. But within about a year and a half, we realized, okay, that may not happen as soon. So then Ma started taking over his practice. She had studied commerce back in college, but that was what, 15 years ago, even at that time? 15, 20 years ago. So every time she went to office, learned new things, she came back and started sharing all of them with me. And at that stage, I was what, 15, 16 years old. And remember, I was still passionate about just understanding how money works, right? And at that age, you start to get a few things. Again, your understanding is very surface level. But at that young an age, if you have the interest, I think that is more than enough, because then you're just more curious about it. And then because of this very practical thrust into the field where Ma used to come back and talk to me about what she had learned, I just grew more passionate about it. Then at the same time, because Baba, as I call him, my dad, he would sort of be responsible for the investment side of our family. Uh, he wasn't able to do that anymore, right? And Ma also wasn't very well versed with it at that time. Now she is. But because of that, I was, believe it or not, it sounds crazy, but I was given the responsibility to look at the family portfolio by Ma. And Baba had set things up. I, at that time, again, had no understanding. So I did not tinker around with anything. I just kept things the way they were. And as we know, right, that's the best way to handle investing. You just let it roll. You Once you have a certain base plan set, just let it roll, because compounding really works with those long term horizons, right? 5, 10, 15, 20 years. So that was a great learning experience, because as I was given that responsibility to look at family money, to look at family portfolio, to see if something needs to be changed, I had to level up. There was a lot of responsibility, there was a lot of trust placed in me. And as a side note, right, because of all of this, the relationship that me and Ma have developed over all these years is very, very unique, very, very strong, where we are there for each other, we share our mind, we um, have, I think, transcended the relationship of a parent and a child. That still exists, but there's a very strong friendship element underlying the entire relationship. But as you can imagine, right, as you can imagine, I was given this responsibility. Ma was sharing all these things. I was already passionate about the field. I never ever thought I would make a career in it, though. I wanted to write thriller novels. I even wrote 4 thriller novels from about the last year of college till 2 years after that. I got licensed in personal finance, specifically in insurance, at the age of 19. I used to do a little bit of work then, but you wouldn't really work as such, right, in college. And then soon after graduating from college, that small effort in the space increased into slightly more effort. And then a couple of years after that, I got really entrenched in the world of personal finance. I wrote for a very big stockbroker in the US to help them simplify certain concepts for their customers. I started helping out Ma with certain aspects of her business that I was interested in. And then soon after that, I got licensed in mutual funds and, you know, Before I knew it, I was working in finance. And the social media stuff, right? The social media stuff on money started in August 2022. I'm a very social media shy person. Never ever thought I'll put up a video online, let alone do it for almost 2.5 years now. And to a wonderful audience of over 500,000 across different platforms. But it's something that I love because a lot of you message me telling me that a certain video helped you or you got term insurance because of me. Or there are some of you who I have actually spoken to one on one or you've spoken to someone from my team and we are actually working with you. And to see the progress that anyone makes, right? Whether we are working together or not, just the progress that you make because of a video that I share is is very, very humbling. It is very satisfying. It just fills me up with a lot of joy. And is this something that I want to keep doing on and on? Okay, so the next question is by Julius, and he asks whether he should buy a land or should buy an apartment. Okay, so one thing that I really believe in strongly, and this may be very different from what a lot of other finance educators in the space think of, I do believe that you need your primary home of residence that you own. So you should own the house ideally that you're living in. Now, the size of the house, the cost of the house, that depends on how much money you're making, how much money you have invested, your portfolio, and things like that. But just having that peace of mind to own the house that you live in is fantastic. There's nothing else in the world that will give you the kind of just comfort and security than that. But when it comes to investing money, right, whether in a flat, an apartment, or a piece of land, that is where things get a little tricky because historically, Indian residential real estate has grown between 7 and 9%. And this is data over the past almost 18 years. At the same time, when you're buying an apartment or a land, you're concentrating all that big money, right? Because apartments and land, they're expensive. Even if you go to the outskirts of a city, you'll get one for what? 30, 40 lakhs on the lower end, but ideally somewhere around a crore, crore and a half, right? Imagine, having all that money just in one particular stock. That increases the risk, right? The risk of concentrating all your money in just one stock. In the same way, when you're buying real estate for investing purposes, you're essentially concentrating a large part of your money in just one property. Now, if that property does well, you're in a great position because you've made a lot of money. But if it doesn't do well, you're in a very bad position because it's not very easy to sell a bad piece of property, number one. Number two, it hasn't appreciated as much. Number three, you just put in a lot of money in it. So I liken the idea of investing in a property to just investing that large amount of money in one stock. It's way too risky. You don't want to ideally do that. Having said that, if you have the expertise to invest in real estate, if you yourself have the knowledge base, if you have someone you can trust, then that is your zone of expertise. That is the zone that you want to operate in, as Warren Buffett says. So go ahead and do it. Now, when it comes to whether you should buy land or an apartment, the potential of land, depending on who you're talking to, the potential of land to appreciate in value is much more because the regulations change over time. There could be a highway project, an airport project that comes up, and suddenly the value of that land really goes up. Having said that, the kind of risk that you incur, once again, not from a price perspective, but from other ways, I share what these are. When you buy land, are tremendous. One big issue with land investing, when you actually buy land, is encroachment. Because if the land is somewhere far away, in a way, from where you stay, then for all you know, the next time you go there, someone has already built a small establishment there. And once someone occupies that land, even though it belongs to you, it is just very difficult to get hold of it once again. It goes into years of litigation. During that, you can't really do anything on it. So it's again money that gets stuck. At the same time, I have a very close friend in the world of real estate. He's a developer himself. Um, he tells me of these very crazy horror stories of how the same land was sold to five people. And yes, you can do a title search, you can do a lot of things, but because there's a lot of money involved, right? Because it's a high stakes game, people do all kinds of dirty things more in the world of real estate than in the world of the stock market. The thing with the stock market is that one share cannot be sold to two people at the same time, right? That one share. Obviously, multiple people own shares of the same company, but the share that you own cannot be sold to anyone else without your approval. There's, I think, more security built into the world of investing in mutual funds because of just the regulations in place, which is even more safer than investing in stocks from a regulatory perspective, risk perspective. So I personally think, A, if you already have a house of residence, a primary home, then explore other ways you can invest money, especially if you're not operating in a zone of expertise, which is real estate. And if at all you want to really, really still invest in real estate, then I think my order of preference would be apartment slash commercial real estate if it's in a good uh, place that will give you a good rental yield. Um, and number two, I would say land. Or I would say number two, three, four are that there are no options, and then number five would be land. Again, this comes with a caveat. If this is your zone of expertise, go for it. Right? Because my zone of expertise is investing in the world of stocks and mutual funds. So I feel most comfortable with that. Moving on to Deep's question, he asks, how do we deal with the current bear market? Should we withdraw? First up, let's breathe in, zoom out a little. We are down by around 13 to 14% on the major indices. Uh, Technically, a bear market is when the market is down by 20% or more. So technically, we're not in the bear market territory, but I can understand why it feels so. Because ever since the COVID crash, we haven't seen similar periods too often. There happened a couple of times where the market went down by about 10 odd percent. But should you withdraw, right? Or what should be your strategy at this point in time? So think of it this way. What is the idea and point of withdrawing, right? Let's say you've invested 10 lakh rupees, that is down by, let's say you invested right at the peak, so that's down by 1.5 lakhs, it's down to 8.5 lakhs, and now you withdraw. What's going to be your strategy? When it comes to investing, enforce second, third, and fourth order thinking. So the first order thinking is, okay, the market is crashing, I need to withdraw. Okay, you've withdrawn. But what is the second implication of that? What is the second order effect of that? That now you have 8.5 lakhs in your bank account. A, it could get spent, or B, even if you don't spend it, you are now waiting potentially for the market to go even lower, right? Because what is the idea of selling investments in the first place? You potentially want to buy them at an even lower price point, so you end up benefiting and making a profit. The third thing, the market stays more or less constant, and now you're in a place where you're not really sure, right, what to do, because it hasn't gone down, so you don't want to invest. And this could go on for a long time. So you could just end up feeling very uncertain, feeling very insecure, not really sure what to do. Thirdly, the market starts rising. And in that case, you're going to feel miserable, right? Because the next time you invest, it's going to be at a higher price point. Or worst case, you would not invest for a very, very long time, because in your mind, you have held that 15% drop as the anchor. Anything below that is wonderful. Anything above that, I'm losing out on money. So having said that, how should you deal with this, right? When it comes to just creating a strategy, if you don't need this money for the next 5 to 6 years, then just let it roll. What is happening right now is routine. It happens almost every year in the stock market. So keep at it. If you don't need that money in the near future, just keep at it. If you need that money in the next 2 or 3 years, you should not have invested it in the stock market in the first place. You should have invested it in safer assets. If it's under 3 years, you should have just invested it entirely almost in bonds or even equity savings funds, which invest about 33%, one third of their money in stocks, the rest in very safe assets not connected to the stock market. So, again, go back to the basics, follow the right principles. So, money needed under 3 years, you don't want to risk it in the stock market. Between 3 and 6 years, perhaps invest 30, 40, 50% of it in the stock market. And over 6 to 7 years, you want to invest 70, 80% of that amount that you have in the stock market through mutual funds. So, Uddhav has a question for me. He says, do we get dividends from mutual funds? Yes, you do get dividends from mutual funds. And there are a couple of ways this happens. Uh, Firstly, what is a mutual fund? It invests in various stocks. What is a dividend? A dividend is your share of the profit that the company makes that it gives away. So think of it as, one of these trees, right, that you can see in the background. The stock price growth is the growth of the tree itself. So what you ideally want is for the tree to grow both sideways and up so that your stock price grows. But along the way, the tree is also going to give you fruits, right? And those fruits are like dividend. So the tree may continue to grow, the fruits come and go. So if a company is making good enough profit and it has on its agenda to distribute some of that profit to its shareholders, then it's given to you in the form of a dividend. Now, do mutual funds give dividends? Yes, because mutual funds own stocks. Those stocks are going to pay, some of them at least, going to pay dividends. What happens to that money that is paid as dividend is it's used to purchase more units of the mutual fund. It's not given to you in your bank account because the mutual fund just uses that money and uses that to uh, invest in other stocks. So, in a way, that's a wonderful strategy because remember, if the dividend from a stock comes to your bank account, then you have to pay tax on it. And the gains that you make through dividends are taxable as per your income tax slab. So you could make 10 lakhs in dividend. If you're in a very high tax bracket, you could end up paying 3 lakhs in taxes. So why do you want to do that? The second way through which you can technically earn money from dividends through mutual funds is through the income distribution cum capital withdrawal option, IDCW. Earlier it was just called the dividend option, but the SEBI changed the nomenclature a few years ago. What does this mean? Look at it again, right? Income distribution cum capital withdrawal. So the income distribution part is directly the dividend that the stocks give out, that is paid to us unit holders if we have invested in the IDCW option. And the capital withdrawal part is that some of the invested money itself, or the capital gains that have happened, the growth in stock prices that have happened, some part of that is also paid out as dividend. So typically a large cap stock will pay a dividend of about 1.5%. And again, much higher paying dividend stocks as well, but let's assume the average, right? 1.5%. So for every 1 lakh invested, you'll get about 1,500 rupees as dividend every year. Remember, the dividend isn't fixed, it varies as per the profit that the company makes. Now, in this case, a lot of mutual funds that are operating in the IDCW option, they give dividends north of 6-7%. How is that possible? Because they're also paying you from the stock price growth or the capital that you've invested, that 1 lakh that you've invested. I don't think you should be investing in the IDCW option because, again, that entire money that you get is taxed as per your income tax slab. The better way to go about this is to set up an SWP. So, again, let's say you want to get 6% as dividend from your mutual funds. If it's through the IDCW option, that entire 6,000 rupees that you'll get on 1 lakh, if you're getting a 6% yield, that entire 6,000 is taxed as per your income tax slab. So if it's 30%, you'll pay 2,000 rupees in taxes. On the other hand, if it's an SWP, then the entire withdrawal is treated as a capital gain. It's not treated as income. So it's taxed very differently. So as per the latest tax laws, every year you get 1.25 lakhs of long-term capital gains tax-free. So in this example, if you are only withdrawing 6,000 rupees per year, essentially that entire amount is tax-free. Fabulous, right? From equity mutual funds or mutual funds and invest, majority of their money in equities. At the same time, if the capital withdrawal of the capital gains, they exceed 1.25 lakhs, then the gains up over and above that at exact 12.5%. So it's just a more efficient way to withdraw money from your investments if at all you need to. So don't look at dividends as even a thing when it comes to mutual fund investing. But yes, the stocks that pay out dividends, you do get the benefits of that because they're just used to buy more units of your mutual fund. Okay, someone named Misra11N asks, insurance, is it even a good option? They're advertising a 1 crore cover these days. I personally think each and every person, if they can afford to, and I'll tell you how you can make it affordable as well, should have a 1 crore health insurance policy, and there's a reason behind it. Firstly, health cost inflation is 14% in India. It has been so now for 2 years, so it's not a one-off event. What that means is that roughly every 5 years, the cost of your treatment is doubling. So a treatment that today costs 10 lakhs will cost 20 lakhs in 5 years, 40 lakhs in 10 years, 80 lakhs in 15 years. That is a scale of increase that is unfathomable, that we can't imagine, right? It just seems very odd that something that costs 10 lakhs will cost 80 lakhs in the next 15 to 20 years. But by having a 1 crore insurance in place, you're able to sort of safeguard the future increase in healthcare costs. Now, you may wonder, okay, but I can always get a good health insurance cover later on, a higher health insurance cover later on, which is a perfectly fair question. But that is where understanding the basics of how you're given health insurance are important. So health insurance isn't just something that you can go out and buy, you have to be eligible for it. So you have to be healthy enough for it. If you develop any critical illness, any life threatening illness, then it just becomes so much more harder to get health insurance. Because think about it from the insurer's perspective, right? They are willing to pay your hospital bills up to, let's say, 10 lakhs, 1 crore, whatever that amount is. But if you already have some underlying major health condition, then they know that you're more likely to get hospitalized. So they know that they'll have to pay that cover amount that you have taken, something close to it. So they're less likely to give you that policy. So you have to be eligible for it. And while you're healthy, while you're young, it's just very easy to get health insurance. So go and maximize that amount. To give you an idea as to how much it would cost to get a cover of 1 crore, I'm assuming you already have a cover of about 10 lakhs or so. In that case, to bump it up by a crore, you need to spend a very small amount. If you're not under 35, that's as low as 900 to 1000 rupees. There's a Niva Bupa plan called Health Recharge that offers you that cover. It's one of the lowest cost entry level top up plans. Not the best top up plan out there. The best super top up health insurance plan, in my opinion, is Tata AIG's Medicare Plus, where for someone under 35, you'd get a cover of 1 crore if you already have a 10 lakh cover for about 4,500 rupees. So it's a very low cost for the kind of cover that you can get. So I think everyone should go out and get it. Okay, then. So we'll wrap up this edition of the Ask Me Anything. We covered a few questions. I wanted to cover more, but the answers became longer than I thought. And it's also getting super cold here. My hands are already freezing. So I'll see you around. I'll tell you very quickly what I am doing here. I think coffee is also getting served at the top, I can see. So I'm at the Side Business School. As I told you, it's the business school of the University of Oxford. And I'm here for a program in artificial intelligence for business. So we are already implementing different AI tools across our wealth management practice. We have also been implementing AI tools for our videos, right? If you saw the Bhagavad Gita video from last week, we actually made small 3 to 5 second, very, very small but brilliant videos of the great Krishna, the great Arjun in the battlefield of Kurukshetra. So just check that video out if you haven't, just for that. Then we are also in the process of creating and using digital avatars for different things, and you will know when they're using AI because we will state it outright. So the entire idea is to be here to spend time with people from different walks of life, from different countries. I think we were told that there are 25 nationalities, about 40 sectors. We're a group of about 60 students in the class. And just exchanging ideas with them, right? It just helps you completely shift your perspective, and that's already happening. I've been here. This is my first time here. I come back 3 times, and it's already happening. Then also, uh, purely again from a knowledge expansion perspective, the Side Business School, University of Oxford have excellent alumni. So being able to have access to them, being able to contribute in whatever capacity I can, is also fascinating. And yes, there's a lot more here, and I will share it in due course with all of you. So thanks for sticking around, and I will see you in the next one.